The US economy performed much better than expected by adding 242,000 non-farm jobs in February versus 195,000 expected and 151,000 added in January. Wages contracted by 0.1%, however, it was the bad news, but it did not prevent the euro-dollar from falling back toward the 1.09 mark this Friday after having tested this week's high of 109.90 just before the US figures. The ECB meeting is due on March 10th, and the market expects at least a 10 basis point cut in deposit rates and a 10 billion euro worth of expansion in monthly bond purchases. So now, the question is whether Mario Draghi could convince the market that additional measures will help to boost the economy and bring back the inflation in the Eurozone. It seems like the recent measures had little impact, and we may expect Draghi to reiterate once again that the recovery is underway with modest growth in the credit market, but it still seems that the pickup is far from what we would call sufficient, and as the time is somewhat limited, the ECB cannot carry on with its bond purchases forever. At some point, the recovery should kick in. The distortion in the Eurozone sovereign bond market is all very much scary in our view. We are moving away from the healthy risk to return consideration, and this may be a red flag for more volatility in the market altogether in the close future. Now, the euro-dollar has eased below 109 mark this week, and the 200-day moving average at 110.50 level seems like it will be sheltering offers before the ECB meeting next week. We have obviously seen a slowdown in the downside trend compared to what we have seen at the beginning of March. The 108.26, just above the 108.10 February lows, have been a support, and breaking below this level, the euro-dollar could easily find itself down to 107.25, 107 levels, and we had argued that these levels would lend support to the euro-dollar a couple of weeks ago. Now it will all depend on Draghi's conviction power next week. Below 107, the attention will shift toward the 105.24, which has been the December dip before the ECB meeting, and potentially down to 105 mark. If the market considers whatever is to happen insufficient, then a rally back above 110.50, which has been the 200-day moving average, will certainly turn the technical indicators on the positive territories and could well signal a further bullish development towards 111.75, 112, and even 113.76, which has been the February peak. It has been a good week for the oil market. WTI is now testing resistance at $35 level, while Brent is looking to take over the $37.50, $38 area. The dollar CAD could ease below 135 level this week, and the Bank of Canada is expected to remain on hold and keep its rate unchanged at 0.50%. The sustainable recovery in oil prices and a consolidation at about $35 levels will certainly give a reason for a further advance down to the 200-day moving average, which is at about 132.95 level, and a break below this level could well bring the 130 mark on the radar. Whether the dollar CAD could keep its slide down to 130 level is also very much dependent on what's going on in the US. Clearly, the US dollar depreciated against all of the 31 major global currencies over the past sessions, mostly due to the softening expectations regarding the Fed's normalization plans. Will the strong NFPA figures bring the US back in demand, or concerns over the contraction in wages pull the market back from developing too much optimism? In our view, the latter would be more likely. It has been the best week for Asian shares in the last 5 months, but the optimism is now subject to Chinese data risks. China will once again be under close watch next week. We have February trade data and January inflation data lined up, and it could well trigger some swings in the global risk appetite and in gold and commodities complex, but also in the Australian dollar. Chinese exports are expected to have slumped by a significant 15% in February, along with a 10.2% slump in exports. A smaller trade surplus is what is expected. The inflation is expected to have remained stable at about 1.8% in year to February, while the producer prices would continue to contract at a pace of 4.9%, still very much of a worrisome picture for the Chinese economy. People's Bank of China cut the RRR rate by 50 basis points last week, we remember, in order to give a boost to the economy. The weak economic figures give China more room for action, but it's still enough if the monetary easing is not done along with structural reforms. We will leave this question here and turn toward the Australian dollar, which had a very good performance this week. Now, the Aussie dollar broke the midterm resistance of 0.7385, which could be the beginning of a reversal for a further extension to 75 cents level. Of course, the dovish expectations for the RBA will at some point creep in to dent the appetite, yet there could be a potential to a rally toward the 75 cents before the market starts pricing in these softer RBA concerns. This was a week ahead with İpek Özkardeşkaya, market analyst at London Capital Group.